Hi, my name is Darren Joseph from General Tax. We're the team that seeks to demystify this sometimes confusing world of international tax and the privilege of having a deep conversation with Mark. Mark, can you please introduce yourself?
I'm Mark Morris. I'm based in Switzerland. I've been here for about 26 years. I've specialized in automatic exchange of information, which originally was the EU Commission's EU Savings Tax Directive. And that went on until about 2014, and they scrapped that and they adopted the OECD's FATCA made into CRS.
So can you share with us what it is you do professionally?
Primarily, I provide custodial services for trusts to hold underlying entities or partnerships or unincorporated funds. So what I do is I provide the administration services for the custodial. I don't do the actual custody. And later on, I'll explain what administration services for custodial is. And I'm an expert in CRS and CARF, and I certainly know the intricate differences between CARF and CRS. We'll get into that in a later question, okay? I've published over 600 articles on LinkedIn, and I'm still writing about 10 a week. And I don't see other people covering 99% of the topics on CRS that I cover.
Okay, thank you. Let's talk about the GAARs, the General Anti Avoidance Rules.
So there's a whole world of anti-avoidance in CRS. The ones that are awake a sleeping dog more than anything else. When I write articles about non-DOMs in the UK, I'm learning what they think. Okay? So they come up with this, first of all, this useless anti-avoidance that's subjective. Did you set this up to avoid? So the next thing is generally accepted anti-avoidance rules. So the way GAAR usually works is if somebody's done something to avoid tax, ignore what they've done. So can you do that with CRS? I've had many people over the years write to me, we'll just ignore what you've done. GAAR doesn't apply to AEI, automatic exchange. It only applies to income tax. And don't try and merge the two together. So there are anti-avoidance rules in CRS, but they're useless, like shift the money to the US, but the financial institution carries on as if he never shifted it. They carry on managing the money. Everybody falls back onto mandatory disclosure rules. And I'll answer mandatory disclosure rules now, because what you're doing is subject to the hallmarks of 6, and you're going to get fined or 5,000 a day. So why did mandatory disclosure rules has been an utter failure? Because it's only adopted by 29 countries in the world, mostly the EU, through their Tax 6. And everybody else said it's not a BEPS minimum. Switzerland, Brazil, Israel, they all said it's not a BEPS minimum, we're not going to implement it. And because nobody else has implemented it, we're not going to implement it. But why MDR, mandatory disclosure rules, failed is they said if an intermediary is based in a country that hasn't adopted or implemented MDR, then he's not reportable. So I can be here in Switzerland. Switzerland actually wrote a letter saying, we're not going to adopt it. Brazil said this impacts on privacy. Then the next thing is if the intermediary, the one that designed or the one that markets these schemes, is not reportable, then the next report is who? Is lawyers. And they said lawyers have got legal privilege. And they went to court. The European Court of Justice said, no, they maintain their legal privilege. They don't report it, they can help advise their client. So then what the brilliant OECD did said, then if there's nobody to report, then the user of the scheme must self-report on himself. And they try to say, if you don't, we'll give you a fine. But
so it's dead in the water.
It's dead. And they haven't done anything. One of the reasons I would say is they didn't make it a BEPS minimum standard. There are 15 BEPS actions, and 4 are standards that must be done. This tax, 15%. So, but this was just optional. And then most countries said, optional.
Ignore it,